Everybody, welcome to the July 2023 Reads Report.
Last month, we were kind of hanging on this 43.25, 4,300 level. We broke out of that in the major averages, in the NASDAQ and the S&P, really not in a lot else. There's some sectors that are doing well, but it's still a very narrow rally. We've come up to this 78.1% or almost there. That's kind of a zone that it's very rare for bear market rallies to go higher than that, but sometimes they reach that point. So it's kind of an area to kind of watch. It's kind of a last ditch for, is this bear even possible? And then the thing that I think is interesting, it's happening now, that's a concern for the rally. In addition, it's still narrow. You're still not seeing breadth confirm it. We'll look at that. But the other thing that's a real problem near term is this decline. We talked about last month how there's going to be a ton of treasury issuance. And the problem is that the biggest buyers of treasuries have been banks. Well, banks can't afford to be buying treasuries right now. Central banks are no longer accumulating US dollar T-bonds. Are actually selling them off on the net, and they're buying gold instead. And so that, and then the Fed, and of course the Fed is the kind of the buyer of last resort, but the Fed is not buying, the Fed is selling. So what have we've had? We've had this big decline in the bond market, and that's a problem. Usually major bull markets that last years and have major bottoms, they're led by bonds moving higher. We had an initial rally in bonds, but now they're really threatening to re-break down. I would watch this 98, 88 level really closely. If we close below that in TLTs, we've already had kind of a breakout in TNXs. Look at this next slide. That's a real concern for the stock market. And we're going to look at that a little bit. So we're kind of in this fragile backdrop where some sectors are still doing well, some countries are still doing well. You probably want to have nibbles there, move your stops up as quickly as possible to break even and let those ride. But you also want to be aware that if we get a 80% down volume back under this 4,300, 43.25, that's a false breakdown. And if we get 70% or higher down volume in the next week or so, that's a correction warning. That would be a real shift in the outlook. So it's a very fragile backdrop, and we really have to watch things closely to figure out if we're going to be able to have some continuance for more months of temporary rally, or if this is getting to the end of the rainbow here. The bond thing to Chuck talked about is one of the weakest markets. This is TNX, a 10-year yield. And it's really, you normally get a big decline in the TNX when you get sustained stock market, full cyclical bottom rallies. We're not really getting that yet, and it's hard to envision because we've got another $1 trillion of treasury debt over the rest of the year that's going to be dumped on the market. We still don't have buyers. The Fed is actually still selling off in QT. The Fed Reserve, the central banks of the world are not buying. The banks aren't buying. And normally, even the NASDAQ starts to become sensitive and fall off when interest rates rise enough. And we're starting to get inches of spillover damage. So if we break down further in TLT, break out further in TNX, it's probably going to start to have spillover damage to stocks and even some of the stronger sectors. So we really want to watch out for that. We can, of course, avoid that breakdown and continue going, but the continued new lows in bonds, long bonds, are going to likely become a problem for the market in increasing size as if it develops much further. So we really want to watch that closely. One of the reasons bond yields are up is liquidity is actually down. Global liquidity is actually down in this period, and that's a problem. And then the balance sheet, we had that big pop that unwound about 6 months of QT, but we haven't had further banking problems yet, at least. And so the Fed has continued to do the QT, and we're now at new lows in terms of the Fed balance sheet. So the Fed is dumping bonds on the market as well as the Treasury. And that's a potential problem. Another thing, I just want to kind of point out, this is the last 100 years of the yield curve. This is the Fed's favorite yield curve, which is a 3-month, 10-year. We also look at the 2-10 and a lot of different variables of yield curves. And a lot of these recessions that weren't signaled by the 3-month, 10 were actually signaled by other different curves. But what I want you to see, even in this Fed's favorite, is that there has not been a time when we have had a big inverted yield curve like this, where we've not had recession. That recession can come anywhere from 3 to 6 months to as much as 18 and even 24 months after that yield curve inversion happens. But it has always happened afterwards, 8 out of 8 times on this, and about 14 out of 14 times on all yield curves. So that's a pretty good track record. You don't want to be fighting that, and you want to just be aware that that's out there. That doesn't mean that we're going to get a recession. We could get a recession in 13 months and that would still be accurate. So what you want to understand is this sort of prognostication of trouble ahead by the yield curve has a really big window. And so one of the things that people do to really watch for, what is this going to impact stocks typically, and that we've talked about before, is when the yield curve starts to steepen. It's not that it inverts, it's that it inverts and then steepens. That's when basically short-term yields are coming down more than long-term yields to uninvert that yield curve. And that's the reason for that is because it's starting to show enough damage on the economy that interest rates are coming down. And you can see this one goes back to 1990, but you can go back to 1950 and it's the same picture. Every time we get the yield curve inverting and then steepening to go above its 12-month moving average, that's when stocks typically take big notice. We don't have that yet. We don't have anything like that yet. We're not close to that yield curve steepening, but kind of know that there's an alarm out there for potential recession or at least substantial deceleration in the economy. And this is kind of when to really, really watch for problems in the market and the economy, is when that yield curve starts to steepen. Until we get that, we could have continued run. But the problem we're seeing, of course, is that that long yield is going up enough to cause problems on its own. All right. We had a little bit lower inflation than expected in the PCE, core PCE, but look at this. Is this a clear downtrend? I wouldn't say so. Here's our target, right? Below 2%. And the Fed's been tightening like crazy, right? And really, all we've gotten is sideways movement. The last 6 months have been between 4.6 and 4.7 on core PCE inflation. We're not able to do anything about it. One of the problems is that this labor gap, this is the demand versus supply of labor gap in the United States, and it's as high as it's ever been since World War II. That's making it really tough for companies to fire labor. And so we've got sort of two things that are kind of keeping us in this suspended animation, if we will, where we've got tightening. We do see evidence of credit tightening. We do see that rates have risen, short-term rates have risen above some key inflation things. So we should start to eventually hit the economy. We do see some areas like in manufacturing and in some interest rate sensitive areas, they're already in recession, but it's not broad-based enough. And so the two things that are keeping us in this suspended animation that may prolong that impact until the later stages of when the yield curve has historically bitten the economy are, we've got the COVID excess stimulus that there's a whole class of people, really upper middle class and upper class, that they got those checks and they just put them in the bank. Right? They just put them in savings. that savings is being drawn upon, but it's not gone yet. So even though a lot of people are facing this inflation that's leading to discretionary income problems, they're drawing upon the savings, and that's keeping consumption up enough so that nobody really fires their workers. And then the other problem we have is this labor shortage that's chronic and bigger than we've ever had since World War II. And that's keeping companies really reticent to fire people because they've had so much trouble hiring. So we've got these two things working that we want to be watching, and that could keep us in suspended animation for a while. And again, here's this estimated excess savings from COVID stimulus that popped up, exploded when we got those checks, and it's being drawn upon, and it's still being drawn upon fairly consistently. Somewhere late in the year, this is going to start to get down to levels where consumption could fall off more substantially. So we really want to watch what's happening.